Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is Lobo Tiggre from the Independent Speculator. Lobo, thank you so much for joining us today.
Happy to be back so soon. Stuff going on. We got to talk.
There's a whole lot of stuff going on. I wanted to have you on because we're seeing the markets just melting down kind of across the board right now. And it'll be a very interesting time to actually see you in person in just a couple weeks here, less than 2 weeks at the Rule Symposium. Link in the description if people are interested in signing up for that and supporting the channel along the way. But your take on what's happening, I know you had said that there was a strong possibility of a downturn like this. So, you were right. And it seems like, big question everyone is asking is, do we have further to fall from here?
Sure. First, I have to, as I always do, stress it wasn't a prediction. I don't pretend they knew what would happen. But the risk to the downside was clear and imminent. And I think the most important thing was that instead of predicting what would happen, as they said, it doesn't make sense to deploy more cash now. And if things worked out the way I hoped or wanted or not, it doesn't matter. The point is that call, not deploying, waiting, is already paying off. Even if you think the bottom is in now, you have better prices now than you would have 2 weeks ago when we spoke, or a month ago when we spoke. And I've been saying the same thing. Now, to answer the question, my sense is still that there is more risk to the downside than to the upside immediately ahead. The 9.1% CPI print in the US was a surprise, shocked everybody. Nobody could have seen that coming except for everybody on your channel, right? Clearly the mainstream is not listening to us yet, Elijah. But all jokes aside, this is serious. I mean, people are talking about a 1% rate hike at the next Fed meeting. And markets are forward looking, they price things in advance. That may be what's happening now. The reality of something that drastic, I don't think the markets are adequately prepared. We could see the broader market crash that you and I have spoken of before, and that would throw out lots of beautiful babies with all the bathwater. So my view is that it's unlikely that anything our audience is likely to invest in or speculate on is about to take off and double in the next week or two, whereas the chances of being able to get that same thing for 50% less or more off in the next couple of weeks as the next Fed meeting looms, I think is pretty high. So my view right now is not, again, that I know what will happen, but rather that the risk to the downside seems greater than to the upside, and that argues for keeping your powder dry, holding on to that cash, until and unless we get offered such stupid cheap prices that we don't care where the bottom is. We're just happy to buy at those prices no matter what.
It is interesting. Yeah, I remember last time we had you on, the title of the interview was "I'm Still Not Buying, Here's Why." And that's exactly what you were saying. You were holding off, but it sounds like you're still not buying right now. You're still waiting for lower prices.
I just had some clients asking me, gee, this stock is down 85% from its peak. It's true, the stock's down 85% from its peak. It's only down like 40% for me because I didn't buy at the peak. So it's still not so compelling that I would want to buy. And the fact that it's down 85% doesn't mean it can't take another. I mean, we haven't had the crash yet. It's down 85% just with resource sector bearishness, which I think we should come back to. I think that's wrong-headed, and I do see it as an opportunity. But it's, we haven't had payday come on the mainstream markets yet for their insane optimism on the transitory yarn. So no, I'm not just saying the same thing. I'm actually saying a similar thing, but if anything, a more urgent version. The fear that we're starting to see right now in the broader markets, I think, is more intense, and I see it as more alarming now than when you and I spoke last. It's not a promise, but that's my take.
Right. And it does seem like, we're seeing new data coming out where, as you mentioned, the 9.1% inflation rate, higher than expected. We're seeing a euro dollar parity at the moment. We're seeing earnings less than expected from banks. If you could expand on that, kind of all the things coming together right now that are really putting pressure on the markets.
Right. So all of that is there. It's not just the pressure on the market. But so, for example, one more thing you didn't put in there, is just out this morning as you and I speak, is the producer price index in the United States just hit another record, 11.3% or something like that. Yeah, so, and those prices have yet to feed through. Now, there's the mainstream is still sort of clinging to this hope of, oh, CPI is backward looking, that's for June, it's already July, gas prices aren't as high. But the reality is that, life is not getting cheaper. The supply chain issues are starting to be resolved, but they're still messed up. I mean, just look at the airports and what's going on there. The bottom line is that the causes of inflation are not something that interest rate fiddling alone can do anything about, absent going truly Volcker. And I don't see that happening. So I think things have to get worse before they can get better. If they get better, and there is a real non-trivial chance that the powers that be trying to fight inflation with the wrong tools will break something in a big way. So I see it more as a systemic risk, if you will, rather than just indicators and trends. These are all just data. But the real risk here is the powers that be doing the wrong things. And it looks to me like they are.
And for our viewers just joining right now, we're again with Lobo Tiggre of the Independent Speculator. Lobo, what I want to ask you about now is, it seems like what we're seeing fundamentally is we're seeing higher inflation. We're seeing earnings less than expected. It seems like we're in a stagflationary period. This should be the best possible situation for the metals, but we're seeing the metals drop. So why is that?
Wait, I thought we'd start with that question.
Sure.
Yeah, what's wrong? Why is it gold? It's the 70s all over again. Stagflation. Why isn't gold going through the roof? I think the last time we talked, my answer was partly, well, really, given the strong dollar, rising interest rates, the better question is, why hasn't gold dropped more or silver dropped more? I still think it's true, but it doesn't satisfy. I understand. We're starting to see everything I said about stagflation, not predicting, but saying I thought it was likely. It's turning out. So why isn't gold doing better? I think it is a fair question. My friend Lynn Alden likes to say that a better comparison is the 1940s, but I wasn't there for the 1940s. And I think that as much as the COVID situation is compared to World War II, it's not the same. And the military takeover of the economy, the consequences of things that were done there, and I think are quite different from the current context. So the 19th, and a critical point is that in 1940, it wasn't, gold price. In 1940, at least theoretically, the dollar was gold. If you were a foreign government anyway, you could exchange dollars for gold. Gold and the dollar, it wasn't just pegged. The dollar was defined as a certain amount of gold. So how gold behaved in that environment is different in the post-Nixon shock world, where the dollar is a complete abstraction with no relation to anything real in the world at all. So I think this inclines me more to the 1970s, and the fact that I remember the 1970s. Even as a kid, I remember, turning my lawnmower money into silver coins and that sort of thing when silver was going up. So here's the thing, and I remember this, I was there, as everybody was talking about gold and silver at the time. You had your bartender would brag about the gold coin he bought, and I never saw the legendary Bernard Brooks shoeshine boy giving me silver stock advice. I would have been the shoeshine boy, but it was like that. Everybody, they didn't just expect. It was like you knew things were going to be more expensive tomorrow, and if you could buy twice as much today, you did before, because it would cost you more tomorrow. That was entrenched in thinking, and this is critical to the gold silver question, the monetary metals. People didn't trust the dollar, didn't believe in the dollar, or they knew that their dollars were getting worth less over time, despite Richard Nixon's assurances to the contrary. That is not the case today. So it's not just, oh, we've got stagflation, what's wrong? We've got incipient stagflation, but we don't have people giving up on the dollar in droves, or people convinced that the dollar is going to hurt them. The latest expectation numbers we got out, and not just from Wall Street and not just from the Fed, but consumer expectation numbers show very high inflation expectations for this year, but not the 3-year and the 5-year expectations. They're almost benign by the time back to 5-year, which means, crazy as it sounds, the average Joe out there, they do think the powers that be are going to succeed, or inflation will come down on its own. They're still buying a version of the transitory story. That's what I'm saying. And drawing this to a close, this is different from the 1970s. This is not the popular belief we had then that the money was just getting more and more worthless. And I think when that changes is when we really see the fire lit under gold and silver. I do think that will happen. As close to a prediction as you'll get from me, Elijah. I do think this is coming. How many times can they move the transitory goalposts? How many times can they proclaim? It's been every month since last December, Elijah. Every month, it's like, oh, it's peaking now, and then we got a higher number. And even by the government's cookbook numbers, you look, it's not just the headline CPI. And yeah, okay, they say, oh, core CPI is down 4 months in a row now. Well, but look at the month-on-month gains. We had high inflation a year ago, so the year-on-year base effect makes it extra difficult for inflation to come in high, which makes the headline number, really shocking. But you look at the monthly numbers recently, and both in headline and core CPI, that's the real shocker. So I don't think I'm just being Pollyanna. I don't think I'm just being a gold bug. Yeah, we're going to win in the end. I think the data supports my thesis. I think we're missing that crucial part of the broader public becoming aware, and maybe asking themselves whether they want to have Bitcoin or gold. Maybe they'll go for both. But as our friend Rick Rule says, the average allocation globally to gold in portfolios historically is something on the order of 2%. Recently, it's dropped to 0.5%. Even if everybody doesn't get religion on this or discover things, even if it went back just to 1%, like half of the historical average, the other half goes to Bitcoin, say, well, that would still double the demand for gold going forward. So I am very bullish. I think there's a missing piece that I think is coming, and that's why I think we are where we are today and why I see it as an opportunity.
No, when we have seen the market, the general equity market fall in the past, for example, in 2008 and the COVID era, it seems like, at least what I've heard is essentially when that happens, there's a lot of margin calls and people go to sell everything. So that might be some of the reason why we're seeing precious metals fall, but typically they will rebound quite quickly. Your perspective on that, is that your take?
Yes, it will be if there is a crash. What we've had so far, I would not yet call a market crash. So yes, that has happened every time that I've seen it, and my mentors, my teachers, my predecessors say they've seen that in the past. But that's talking about acute moments when you get that V-shaped recovery, where gold gets sold not because people want to, but because it's the only thing they can sell. They get margin calls. Their margin clerks are doing their selling for them, right? And we saw that in 2020. I saw that as well in 2008. And I would expect that if we do get this near-term crash, but we're not there yet. So no, I don't think it's liquidity causing people to sell gold right now. If anything, the strongest variable that I see in the data, and just like this week and in the last month and all year long, has absolutely been the dollar. Brent Johnson, the dollar milkshake guy, I don't know if you've interviewed him or not, but you probably have heard of his dollar milkshake theory, which is basically a strong dollar thesis. That has clearly in the data shown itself to be the strongest headwind for gold this year, more so than the change in interest rates, interestingly enough. And right now there is, with the global geopolitical situation, the awareness of, this recession thing becoming real, and it's global, it's not just US, there is a huge flight to safety into the dollar milkshake. And that is, I think, proving quite challenging to gold. We've seen that. If you saw my digest last Saturday, if you saw the chart I put in there, but the gold and dollar charts, it's like a Rorschach, where they fold the ink blot. It is so close to a mirror image. Very strong explanatory. So the good news is that, eventually the emperor has no clothes. The dollar strength turns into dollar weakness, and that'll be good for gold and silver. The bad news is that doesn't necessarily happen right away. And whether they should or they shouldn't, people are flocking to the dollar right now. And that is right now, I think, why we see gold under pressure, even though, as an inflation hedge, it should be doing well in a time of high inflation.
Now, when it comes to other markets, I know you have mentioned actually that uranium is not reacting to these other market movements at the moment. Why do you think that is?
It's too early to declare victory and that, yay, uranium has divorced itself from the broader markets. I do think that's coming. But just to frame the question a little bit, rewind a bit, and we've seen a lot over the last couple of years of times when it's crazy. Uranium itself, the spot price will increase significantly on a day, but the broader market's having a really bad day, and uranium stocks will drop. And stocks are stocks, but it's not just that stocks are stocks. It's more like if there's bad economic news, people think, oh, well, that's bad for energy, and uranium is an energy play. So the energy sector will drop, the uranium stocks will drop, even on days where uranium itself is going up. So there's been this, that's on a day-to-day basis. Obviously, since uranium bottomed at $18 5 years ago or whenever it was, uranium and uranium stocks have risen, and regardless of what the markets did. So the bigger, longer term I'm saying is that uranium and uranium stocks do follow their own trend. On the short term, there's been this perverse relationship with the stocks getting sometimes a tailwind or sometimes getting whacked based on the broader markets. Lately, there have been some days where that hasn't happened. There's been some days where we've seen a significant downturn on the broader markets, and uranium stocks were up. So that is evidence. I think it's too early to conclude this, but it's starting to look like people are getting a clue. You've got Japan restarting. You've got even Germany, of all places, thinking about not turning off its last surviving nukes. And that may be percolating into the markets and beginning to separate. But just to draw this to a close, I think what really needs to happen here, more than the Japanese restarts, no disrespect to my friend Rick Wool, what really needs to happen is for long-term contracts between miners and end users to be signed at substantially higher prices. That, by the way, these can be 5-year contracts. So you have 5-year contracts at higher than spot prices. I think that really puts a floor under uranium and probably pushes it higher. And that floor, I think, enables them to be divorced from the broader markets. Like if this sector starts having long-term contracts at higher prices and the broader markets go down, you could actually see people seeking alpha, right, looking for yield, rotating into the uranium stocks because of these long-term contracts. So that's the key variable I'm looking for there.
All right. Well, Lobo Tiggre, if our viewers are interested in listening to you, they can go to independentspeculator.com. Great website. All our viewers should check it out. Also, they can meet both of us in person at the Rule Symposium in Boca Raton, Florida. Link in the description if you'd like to sign up and support liberty and finance along the way. Any last thoughts before we let you go, Lobo?
Just real quick for the 2 or 3 people that haven't tuned out yet, commodities is a big thing. I really think of monetary metals as separate from pork bellies and coffee and copper. So if I'm right about stagflation could be weak growth or it could be inflation and recession. And if the recession is strong, it's going to be harder for the industrial metals to recover than for the monetary metals. So just keep in mind that the stagflation environment isn't necessarily great for everything. We'll have to see how hard the recession is and maybe whether the green agenda compensates for that. There's a lot more in there. All I'm saying is I'm not rushing to buy everything. Okay, copper, oil, other things, I might hold back a bit. Gold and silver, if I get stupid cheap prices in a market crash, I buy those right away. Oh, and uranium too.
All right. Well, Lobo, thank you so much for your time and making this interview a last minute live stream because we saw the markets moving so quickly. Thank you so much for your time and God bless.
Happy to chip in.